Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Wednesday, July 17th, 5:09 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Roundup Daily Market Insight video. Market state, we're in an uptrend since May 6th. We've seen the status isn't the right word. Let's say the makeup of the uptrend change 180 degrees from what we've seen beginning on May 6th to what we've seen over the last week. This started with the CPI report last Thursday. And by that, to clarify, I mean the market, the rally off of the May lows was led by, it had its share of growth leaders, but primarily led by tech growth, the big eight. And last Wednesday, we got so extended to the upside, we put out the yellow warning light on the trend gauge over there, and that proved to be pretty accurate on the timing of that, as the Nasdaq 100 has gotten slammed since then. That indicator was a warning that we were extremely extended to the upside. And when you get the rubber band can only stretch so far, and this goes for really anything in the market. And once it stretches too far, it needs to snap back in the other direction. And that's what we've seen with the NASDAQ 100 for the longest time during this rally. Mid and small caps grossly underperformed their big cap counterparts. And that got turned on its head last Thursday, as well, as they went straight up off of the bottom. Nice breakout, got extremely extended yesterday, and gave some of that back today. Today was an ugly day in the market, unless you're into big cap value. Actually, mid and small cap value closer to flat than they were down. But let's go to the trend gauge over here and we'll talk through this. So leaders, I don't ever recall 21 out of 21 of my leaders list being negative on the day, but that's what we got. And that's enough to downgrade market leadership to neutral. So you see the yellow arrow there. Short term, for quite a while, the first 2 months of this rally, all we had was the NASDAQ 100 and the big names from there carrying the S&P 500 to the green arrow, and everything else was suffering. Well, that's been turned completely on its head, and now the first of the five indexes to break the 21-day moving average is the NASDAQ 100. When rotation happens, it sometimes happens very quickly and very severely, and that's what we're seeing now. So although we've still got the three arrows across the three time frames that we track, that's the short-term 21-day moving average, the medium-term 50-day moving average, and the long-term 200-day moving average for the five major indexes. The first move lower below the 21, as I said, the NASDAQ 100. So we've got the yellow sub arrow out there. NASDAQ listed under neutral, 50-day and 200-day still above those levels for all five of the indexes. So what happened today? Overnight, there was let's say a triple whammy hit the semiconductor sector. First of all, ASML reported earnings and they missed on guidance. So that was the first shot across the bow. Then Trump came out and said that we wouldn't necessarily support Taiwan unless they paid up for the support. Of course, Taiwan Semiconductor is a huge manufacturer of semis, and they took it on the chin on that, being down 8% on the day. And then Biden, the administration said that they were going to further toughen the restrictions on chips being allowed into China. So the chip sector hit with the triple whammy overnight that carried over to the whole sector, carried over to the tech sector, carried over to all of growth leaders. Surprisingly, maybe not so surprisingly, but there was not an our 21 over 21 list always has at least 10 different sectors in there. And when you've got all 21 stocks down, that's not just tech, very clearly. So here are the final numbers on the day, but it wasn't a total vacate of the market. Value, the value half of the major indexes was up across the board, and we'll break it down as we go through it. But the 21 over 21 down an average of 4.48%. Like I said, all 21 down. The big eight, all eight of them lower, down an average of 3.11%. The RG8, all eight lower, down an average of 2.45%. Now we get to the S&P 500. It gapped down by 1%, anemic rally the first 30 minutes, and then trended lower for 3+ hours for chopping into the close and closing near the low of the day. S&P 500 down 1.4%. Within that S&P 500, the growth half was down 2.9%, the value half positive by 0.6%. So again, you can see massive rotation into value, and it wasn't just in big caps, it was in all caps. Equal weight S&P 500 only down 0.4%. And again, that's indicative of money rotating into the value sectors and them being equally weighted as opposed to the heavy tech weighting in the S&P 500. And speaking of heavy tech weightings, the NASDAQ 100 down 2.94%, equal weight down 1.8%. The Dow, the lone bright spot on the day, this is a value index, up 0.6%, led by United Healthcare, high price stock, up nicely on the day. Mid caps down 1.4%. Mid cap breakdown was growth down 2.2, mid cap value down not as much, down 0.6. Russell 2000 small caps down 1.06%. So these two indexes continuing their outperformance relative to big tech anyway. Not the Dow today, obviously. But the breakdown on the Russell 2000 was growth down 1.8% and value basically flat. The 60/40 broad index worldwide, that's worldwide stocks, worldwide bonds, down 0.73%. Our in-house flagship portfolio, GROTECTION, down 1.67%. A lot of stops taking us out of the market. We'll go through it as we break it down, and let's start off with the S&P 500. You can very clearly see how we had been trending above this 8-day exponential moving average. Drew a nice trend line there, break below that trend line, still above the 21-day moving average, still way above the 50-day moving average. Let's contrast that with the NASDAQ 100, where this big negative reversal last week with the CPI report. We had 3 inside days versus that. Big gap down, closed near the low of the day, breaking the 21-day moving average, also breaking below that 487 support level that we busted out above. So this has come apart pretty quickly, and a couple of them are holding up, some of them not holding up as well. I'm talking about the big eight. Let's go to the Dow Jones Industrial Average, the champ of the day. Massive relative strength over the last week and a half. All-time high, up 0.6%. Let's go to mid caps, which have been on a tear, starting with CPI last week, got a little too extended, giving some of that back today, still above the breakout level of 30.50-ish. And you can give back half of this move and it still be that's kind of the rule of thumb. You can give back half of a move at any time and still have it be considered the trend, not broken. So we'll be keeping an eye on this 30.50 level on mid caps. Russell 2000 small caps, pretty timely in getting rid of our leveraged ETFs on this yesterday and switching into the small and mid cap dividend ETF, SDVY, which was only down 0.72 on the day. Russell down 1%. And again, you can see the big 5 days up, made a higher high today, gave back some of it. Still very clearly a strong breakout. No problem with that whatsoever. Now let's break this down into the value and growth half. We'll start with growth. That still looks fine. And the value half is going to look even better, IWN. Still very clearly above the breakout. Let's split the S&P 500 down. Let's go with SPY G. Here's the growth half breaking below the 21-day moving average. About SPY V, the value half, made a higher high today. So bifurcation, again, this is why we Love the S&P 500 as our cornerstone for the portfolio, all rotation, and you can't keep up. We can't anyway. Maybe there's some genius out there that can, some algorithms that can. But all the rotation takes place within the S&P 500 when you go from sector to sector, value to growth. And that's what we saw today with it down. I mean, not cool that it's down 1.39%, obviously, but much better than being down 3% or more with all where all the tech uh, heavy indexes are. And we get our value exposure in the S&P 500 because we primarily traffic in mid, small, and big growth names. That's the pond that we fish in. Those are what outperform when the market winds are at our back. And the market winds shifted a little bit today. And really over the past week to, really a swirling wind. It's benefiting some things, not benefiting others. But we do have reference points today for the NASDAQ 100. And one of the key things that we will be looking at is what happens if this on the action, when the 21-day rolls over, it's basically flat now. When we rally back into the 21-day moving average, will it be recaptured, or will that be a great place to put back on an SQQQ short, which we booked a small gain on today with the break below the 21-day moving average? So that is one of the primary things that we will be keeping an eye on over the next couple of days is what happens when this rallies back up into the now declining, or it will be declining if we uh, open anywhere near the close today. What happens when you go into a declining 21-day moving average? This has been a pretty harsh sell-off, and let's look at two other ETFs. The FANG Plus Index, which is FNGS. This is an equal 10% weighting of the big eight plus AVGO, Broadcom plus Snowflake. You can see that broke below the 21-day moving average. The straight up Magnificent Seven, MAGS is the ticker for that, broke the 21-day moving average as well, down 3.3% on the day. So we want to see what happens if these names, because of the big weighting that they have on the index, what happens if they will they attempt to challenge their 21-day moving average and recapture it, or will it fail and put the 50-day moving average in sights? We've also got things complicated by the fact that today begins a weak seasonality period for July and August and September. Not to say we're guaranteed to go down, but from a seasonality standpoint, this is kind of when we topped last year as well, mid to late July, selling off into November before a strong rally started. So though that's the key, that's what we want to keep an eye on. Let's go to the inter-asset correlation. Now we'll start with the VIX. VIX really not up as high as I could have expected it to be. Did break back up above all the moving averages, but still below that 15 level, up 9.8% on the day. We also want to keep an eye on whether or not this is going to signify a range expansion on the S&P 500, as that tends to be bearish when the range and expands because it just signals volatility picking up. Volatility is typically tamer when you're in an uptrend. Let's go to the US dollar. Can't blame the dollar or interest rates today for going down. In fact, the dollar dropped and broke below the low. This is typically considered bullish for stocks, down 0.5%. Let's keep an eye out for a bounce on the dollar back into that 104 level and see what happens there. That's the dollar. Let's go to precious metal complex, GLD, made a higher high and reversed. GDX made a slightly higher high and reversed. And SLV had an ugly day. We trimmed our silver ad today. Anytime you get more than your first buy on and it reverses immediately, we really don't mess around. Get rid of it, because that means something that you were planning on happening. And in this case, a very nice floor with corresponding with the 8-day moving average and a nice bounce off of it yesterday for silver. At a minimum, any pullback should have held that 28 floor. It didn't. We busted clear through it and then broke through the 21-day moving average. So that got sold today. How about Bitcoin, IBIT? kind of an inside-ish day, a little bit of a higher high, but somewhat tame after the two prior big up days. Let's go to bonds now. Not a lot going on in bonds today. Made a higher high on price, just barely. Not a lot going on the yields either. Here's the TLT, slightly higher high in price, and the yield on the 30-year down slightly. The yield on the 10-year down. So that's our major interasset correlation. Let's go to the tail of the tape here. I talked about the triple whammy for chips. Day count clearly varied before today, depending on which sector or which index you were talking about, but we'll call it down one today with just the Dow eking out a gain. This broke the streak on the S&P 500 above the 8-day moving average, still the 32 days above the 21-day moving average for the S&P 500. Our expectations downshift to neutral, with us having a mixed bias versus the 21-day. S&P up, NASDAQ 100 lower. You can see where we are versus the various levels there. Sectors, all defensive sectors to the upside. Energy, financials, that included banks too. Staples, utilities, medical, and real estate. To the downside, silver, gold stocks, industrials, and then Chucky. That's XLC, XLK, XLY. Those are the three tech ETFs. Semiconductor, software, transports, and despite interest rates being flat, ITB down, but ITB really screamed to the upside over the last 4 days. Changes to the portfolio. Stops took us out. We don't argue. CrowdStrike, CCJ, that's uranium, SMCI, bad failure on the breakout. Uber failed on the breakout. ARM pulled back near flat from our gains, stopped on all of those. We did some offensive selling on the inverse ETF, SQQQ, booked a small gain on that, and we hedged NVIDIA with NVDS. So that took our adjusted beta down from 1.28 to right about 1, which is where we're comfortable being. First of all, we've got a floor. We set a floor in-house of a 1 as long as the S&P 500 is above the 21-day moving average, and it is. So we're basically at the floor there. And the fact that it's still above, and we saw all the defensive sectors today, that's what the S&P 500 is designed to do. Handles all of the rotation. And as long as you're above the 21, that indicates that the short-term trend is up. Don't argue with it. We get taken out on some more stops, we will. But we're cognizant of what happened today, and we're cognizant of the bottom line that growth leaders slammed on a huge rotation into value names today. So we're of this 1.01, 70% of it is index ETFs, including ETFs, some defensive index ETFs like RSP, which is equal weighted S&P, and the SDVY that we went into yesterday, which is dividend, mid, and small caps. So then 30% is left for the growth names that we're in. You can see what we have left in the portfolio. Silver, NVIDIA, which is half hedged, Apple, Coin, GLW, and HIMS. And we're slightly underwater on HIMS, stopped on all these today, either locking in gains or small losses. And we'll see what tomorrow brings us. We've got the levels that we'll keep an eye on across all of the indexes. But for now, we're going to show the carnage. No need to panic. We come into every day knowing we use two formulas. The first one is called RVAB, Revere Volatility Adjusted Beta. That lets us know how much risk we have in our portfolio. And the other one is REBAR, Revere Estimated Balance at Risk. And all that is how much will you lose on the overall portfolio if all of your stops get hit? We came into the day with an 11% gain since this most recent uptrend. And the downside, if all the stops got hit, was about 4.5%. So we knew, regardless, that we were going to at least lock in a 6.5% gain from this most recent trend higher if all of our stops get taken out. And when you're comfortable with that, you can be comfortable with hard pullback days like this because it's all baked into the stops across the portfolio. And if they get taken out, you get taken out. And that we know what our drawdown is if that happens. So let's go through the 21 over 21. All of them negative. We'll point out the relative strength. And these first few are very clearly showing relative strength. GLW continues to be a champ, not even touching the 8-day moving average since they raised their sales guidance. Coin, a little bit of volatility today, but it did make a higher high and down less than 1%. I consider that a victory for any growth stock like that. Palantir, kind of an inside day, still holding the 8-day moving average and its breakout, so that's pretty good. ARK-K, 3 strong days up, inside day, giving some of it back, almost 2%. I haven't gone through all of the holdings in ARK-K yet today, but I will before tomorrow. XBI, 8 straight up days, giving back a little bit of it is completely normal. That's biotech. ITB, 4 out of 5 strong up days, giving up partial of yesterday's is completely normal, down 2%. GDX, again, straight up from 35 to around 40-ish, giving back 2%, no big deal. Apple broke this ADMA uptrend, down 2.53%, not heavy volume, normal pullback after a nice strong uptrend. Tesla still holding the 8-day moving average in that 250 level. Lilly, there was some news on this. Roche, another drug company, got not approval. It got positive review on one of its phases for an oral weight loss medication, and that hit the entire complex. VKTX down 12.5%, NVO down 4%, Lilly down 4%, and breaking the 21-day moving average. Weatherford, normal pullback for an oil name. HIMS, pullback after bigger than we would have liked to have seen, but lower volume than the 4 up days. These are the little clues that we're looking for. If this pullback is just a pullback and we actually get some good growth names, this is one of them. From the small and mid cap, it is a $4.7 billion company. It came back normally to the 8-day moving average as it's trying to complete this cup, and below average volume. So these are the things we're looking for. What's going to make a higher high above today and yesterday's highs? Those are your true champs, and that's what we'll be keeping a lookout for. Rose, hard day, pullback, but it was after 4 up days. This is on the volatile side. Hate it to see it down 5%, volume below average versus the 4 prior up days. COHR broke the 8, still above the 21, down 5.8%, volume on the above average side. Then again, it was tech, and anything AI data center related got slammed today. There's NVIDIA clearly breaking the 21, holding the 50-day moving average, down 6.6%. Volume heavy. Don't like to see that. And the volume pattern's clearly negative now since the negative reversal a few weeks back. And that's why we hedged half of what we have. As long as it holds the 50-day, we won't blow it out, and we'll keep the hedge on for taxable accounts with big gains. SMCI failed breakout from 3 days ago, breaking the moving averages, ugly. AppLovin, break the 21 and the 50, ugly. Datadog, clear break of the 21, sitting on the 50, ugly. CCJ, hideous. After a big move up on massive volume, a tight range day, 4 down days, and then the largest of the down days breaking the low of the base, ugly. Uber, failed breakout from yesterday, broke the 21, sitting on the 50-day, ugly. ARM Holdings, breaking the 21, down 9.6% on average volume, also ugly. And that's how you get 21 leading growth names down an average of 4.5% on a day like today. But that is cushioned by the fact that we've got the S&P 500 in our corner and the rotation into the value sectors from the S&P 500. This cushions our portfolio when the growth names get sold off. And that's going to wrap it. As always, like to hear from you. The email's don@revereasset.com. The phone's 855-REAL-WEALTH. That's 855-732-5932. If you're interested in becoming a client, my partner, Dan Stewart, dan@revereasset.com is who you want to email. And a reminder, our flagship portfolio is named GROTECTION because it has a dual mandate, that is grow assets during uptrends, protect them during downtrends. This doesn't even look like a downtrend has started with us still being above the 21-day moving average. That's the first, and the fact that that's above the 5,500 level, if it breaks that and the 5,500 level, which was a breakout area, we'll get more defensive, no question about it. Or if some of the things that we're owning um, get their our stops take us out, not our opinions. So that's where we are. And with that, I will wrap it for Wednesday, July 17th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.